Hey everyone, welcome back to Corporate Decoder. Today we're going to try and make sense of a company filing that's got more numbers than a phone book and a story that's, well, let's just say it's a wild ride, so grab your popcorn. Before we dive deep, if you love getting the real scoop behind corporate numbers without all the jargon, smashing that subscribe button is your first step. We've also got a fantastic community over on Discord, linked in the description below, where you can hang out and chat about these deep dives. Alright, so we're looking at a filing from Artificial Intelligence Technology Solutions, Inc., or AITX as they call themselves. This company is aiming to use AI to solve business problems mainly in the security and facility management world. They're talking about robots that can patrol, respond to issues, and even manage access. It sounds pretty high-tech, but as always we need to check the numbers. First off, they've checked the box for non-accelerated filer and smaller reporting company. What that means in plain English is they're still on the smaller side and don't have to share quite as much public information as the really big players. This can sometimes make it harder to get a clear picture, so we need to be extra careful. Now let's talk about money. They've got this thing called an equity financing agreement, which basically means they can sell their stock to an investor, AIV Investments, to raise money. They can sell up to $30 million worth of stock. This agreement lasts for 2 years. What's interesting here is they're not selling new shares, but shares that were already registered. It's like they're releasing them into the market. They control when and how much they sell, which gives them some flexibility. And that brings us to the specific number of shares we're talking about in this filing. 123,916 shares of their common stock. This isn't entirely new shares, but part of a larger agreement. Now, before we get to the juicy financial numbers, let's quickly touch on the risks. Companies have to list these out, and AITX is no exception. They're upfront that their business is young, they're not yet profitable, and their auditor has expressed doubts about them being able to continue operating smoothly. That's a big red flag right there. They also mentioned that their future financial results are hard to predict and that they might not be able to manage their growth effectively. Here's a really important detail. The people who own their common stock don't actually have control. That's because the CEO, Steven Reinhardt, holds Series E convertible preferred stock, which gives him 2/3 of the voting power. So he calls the shots. This concentration of power can sometimes lead to conflicts of interest. This part talks about what happens when AIV sells those shares. If they sell a lot of them, it could drive down the stock price and dilute the ownership for everyone else. It's a common risk with these types of financing agreements. All right, let's get down to the financials. This is where we see how the company is really doing. For the 3 months ending May 31, 2025, their total revenue was $1,854,837 in the same period last year. This is a 57% increase, which sounds great on the surface. Most of this growth, a 66% jump, comes from their device rental activities. This means more clients are renting their robots and systems. Direct sales of goods and services also saw a 13% increase, boosted by training revenue. Their gross profit, which is what's left after the cost of making their products, was $233 and $533 and $534. Their gross profit margin also improved from 58% to 67%. This is largely because rental revenue, which has higher margins, is making up a bigger piece of the pie. However, despite the revenue and gross profit growth, they're still losing money overall. Their loss from operations was almost $3.2 million for the quarter. While this is a smaller loss than last year's $2.8 million loss on an operating basis, it's still a loss. And when you factor in everything else, their net loss for the quarter was $4,594,018. This is also an increase in losses compared to the previous year's net loss of $4,194 gross profit. The overall business is still losing more money. Looking at their cash situation at the end of May 2025, they had about $324,844 and $855,975 at the end of February 2025. With their current spending rate, this cash won't last too long without more funding. In fact, for just those 3 months ending in May 2025, they used $3,321,185 in cash just to run the business. This is a pretty significant burn rate. Now, let's peek at their balance sheet. Think of this like a snapshot of what the company owns and owes at a specific moment. At the end of May 2025, their total assets were just under 10 million in assets. This is where it gets really interesting. They have something called stockholders deficit, which means the value of what everyone collectively owns is negative. It was about 50.5 million in by a lot. Let's look at the full year numbers too. For the year ending February 28, 2025, their revenue was $6,130, an 885% increase from the year before. That's really strong top-line growth. Their gross profit also saw a huge jump, up 562% to $3,744,564, and their gross profit margin improved significantly from 25% to 61%. This is thanks to those higher margin rental revenues we mentioned earlier, and also because they had some big inventory write-offs in the previous year that skewed those numbers. However, their operating expenses also went up by 22% to over $17.6 million. A big chunk of this increase was in general and administrative costs, which went up by 36%. This includes a big jump in wages, salaries, and commissions, partly due to more staff and bonuses, including a significant bonus for the CEO. Even with that massive revenue growth, they still ended the year with an operating loss of nearly $14 million, which is almost the same as the previous year. And their net loss for the year was almost $19 million. While that's better than the previous year's net loss of over $20 million, it's still a substantial loss. Looking at the balance sheet for the end of the fiscal year, their liabilities were about $60.5 million compared to assets of about $11 million. Again, liabilities far outweighing assets. And their stockholders' deficit was around $50 million at year end. It's clear this company is burning through cash and has a long, long way to go to become profitable. And here's something from their auditors, LJ Soldinger Associates. They've issued what's called a going concern warning. This is a big deal. It means the auditors have serious doubts that the company can actually stay in business for the next year. They mention the negative cash flow, the accumulated deficit, and the negative working capital as key reasons for this warning. Now let's talk about who owns what. Steven Reinhardt, the CEO, is the major player here. He owns over 66 billion shares, which makes him hold about 75% of the company. Remember how we talked about him having voting control through preferred stock? Well, this shows just how much of the company he effectively controls. This section often has some interesting details about how money moves within the company, especially between the company and its leaders. It looks like there were significant payments to the CEO, including deferred compensation and bonuses, which adds up to a lot of money. They also spent a lot on research and development from a company partially owned by a principal shareholder. These related party transactions can sometimes be a way to enrich insiders, so it's always good to keep an eye on them. Looking at executive compensation, the CEO, Steven Reinhardt, took home a hefty sum, with his salary, bonuses, and stock awards totaling over $4.3 million for the fiscal year 2025. His chief financial officer, Anthony Brenz, earned a more modest $200,000. While performance-based compensation is normal, it's always worth noting the scale when the company is still trying to figure out how to become profitable. They have a massive amount of authorized stock, 20 billion shares of common stock and 20 million shares of preferred stock. This is a huge number, and it means they have a lot of flexibility to issue more shares in the future. This can be good for raising capital, but it's also a clear sign that significant dilution is always a possibility for existing shareholders. Now, something many investors look for is dividends, which is when a company shares its profits with shareholders. AITX explicitly states they do not anticipate paying dividends in the foreseeable future. They plan to reinvest all earnings back into the business. So if you're looking for income from your investment, this isn't the place there. Now for my take on AITX exist. So what's the story here? AITX is in an exciting field, AI and robotics for security, which has huge potential. They're showing impressive revenue growth, mostly from renting out their robots, and their gross profit margins are improving. That's definitely a positive sign. However, the red flags are pretty hard to ignore. The company is still losing a lot of money. Their cash position is precarious, and their auditors have raised serious concerns about their ability to stay in business. What's more, the control is heavily concentrated in the hands of the CEO, and there's a lot of debt on their books. It's a classic high-risk, potentially high-reward scenario, but right now the risks seem too significant, and their auditors have raised serious concerns about their ability to stay in business. What's more, the control is heavily concentrated in the hands of the CEO, and there's a lot of debt on their books. It's a classic high-risk, potentially high-reward scenario, but right now the risks seem to significantly outweigh the rewards based on these numbers. They need to find a way to turn that revenue growth into actual profits and manage their cash burn much more effectively to overcome the going concern. Alright, that's our deep dive into AITX's latest filing. What do you think? Are they on the cusp of a breakthrough, or is this a company to watch from a distance? Let me know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and definitely subscribe for more unvarnished looks at corporate filings. And remember, our Discord community is always open for discussion, so join us there via the link in the description. Thanks for watching, and I'll see you in the next video.